Welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we'll start off with the S&P 500 as we always do, and it's been quite an interesting week because when we spoke this time last week, the market was kind of grinding higher, and then it sort of fell in a bit of a heap on the Thursday thereafter.
Yeah, that's right, it did. We looked at the S&P 500 as we always do every week, and at that stage we pointed out a little triangle pattern that I'd said looked as if it was bound to break to the upside. And you can see that indicated over there. And it did in fact break to the upside. It was that day when we recorded the show last week Tuesday, that it did break out. The breakout level was 2480, and I said at this time, I think it was my exact words, I said it looks like it'll just be a hop and a skip to 2500 if it breaks out through 2480. And the thing is, it broke out, it went above 2490 briefly, and then it saw a massive reversal back down, and you can see that indicated by the long tail to that candle on the upside over there, and then the market closed back inside that triangle. Now it's quite interesting when something like that happens, because that effectively is a false break that then happens outside that triangle, and what it implies is that the buyers simply didn't have the gusto to push it higher, and the sellers overpowered the buyers and pushed the price back in, and it's quite unusual to see that, but when you do see it, it's worthwhile paying attention to, because when I noticed it that evening, I actually thought the fact that it's reversed back inside the candles, quite back inside the triangle, is actually quite serious, and probably means it's going to break out the other direction quite violently. And that's exactly what happened. You can see that we then saw Wednesday the market was off a little bit, but then like you said, Thursday last week there was quite a big sell-off to the downside. The S&P 500 went down, flushed through the 50-day moving average over there. You can see there is an upward trend that's still intact there, so that's still, from a technical standpoint, is fine. And there's positive reverse divergence on the stochastic over there, which is basically all it's saying is that this market is now more oversold on this recent pullback than what it was on that previous pullback at the beginning of July. And usually that can set up another move to the upside. So whether it will or not this time remains to be seen. From our perspective, it would be nice if it came a bit lower into September, because our put spread option structure that you can see the payoff on the right hand side there, we've still got this open. It runs out until the 15th of September, and if the market goes below 2430 by then we'll be in the money on that structure. So that would be nice for us, but it's a month away, so anything can still happen.
But I know that you've got charts of, and you often bring up sort of charts that show seasonal patterns in the market, and August and September generally aren't great months. No,
they're not. So this is just an interesting chart. I know I showed it a few weeks ago, but I'm obviously keeping my eye on it at the moment. It's a seasonal chart of the S&P 500 that looks back over the last 20 years. So what they've done is they've taken the year-to-date pattern, or the performance every year for 20 years, averaged it out and said, well, what does it look like on average over a course of a year? And you can see obviously it starts at 0%, because you start the year at 0, of course, and then you're typically fairly strong into the first and second quarters of the year, but then these middle months of the year are very dull and choppy, and in fact in August and September that is seasonally quite a weak time on the S&P 500. You get that pullback typically, and then you get a nice powerful rally into the end of the year from October through to the end of December. So if that is to play out again this year, that would probably serve our purposes quite well in terms of the way we're positioned in our option structure at the moment. And in my ideal world, I suppose we would look to try and bank a profit on that option structure, and then look to try and put some sort of long structure on for a rally out into the end of the year based on this seasonal pattern.
Yeah. And what about our own market? Because that's also been quite interesting. We followed suit from Thursday's drop to the downside in the US markets. And I think last week, was it that you spoke about a gap in the top 40?
Yes, that's right. So this is a top 40 future that we look at here. And I did point out a gap last week, which I said at that stage it might be an exhaustion gap. An exhaustion gap often happens when you've had a massive rally. It can happen to the downside as well after a big sell-off, but basically it's a gap in the chart that often illustrates, like the name says, an exhaustion, a blow-off to the top in this case. And you get that gap up, and then quite quickly the gap gets filled, and then the market comes off again after that. And the fact that that gap was filled the very next day suggests to me that it was actually an exhaustion gap. And also what's happened subsequently is you can see the top 40 is broken below that upward trend that goes back to July. So it looks as if we are into a period of consolidation over here now that may still last a little bit longer. How deep it pulls back remains to be seen, but obviously again from our perspective we've got an option structure, put spread structure once again. It works for us below 48,000. So anything below 48,000 we would be happy with in our portfolio, because that would start to make us some money. And we've got about 5 weeks. This expires on the 21st of September. So we've got about 5 weeks to go on this structure. So, you know, anything can still happen in those 5 weeks. And I can trade around it and possibly, you know, as and when I see an opportunity, I perhaps could get long against the structure if I think that that's necessary. Or I could just leave it if I think the market's going to go lower and fall into that sort of sweet spot zone.
I mean, we're really reluctant for the market to go anywhere higher, aren't we?
Well, purely on these on these two structures that we've got, I suppose that is the case. Where we are quite keen for it to go higher is on Unilever, and we've got that. We'll talk about that in a moment. But what I quickly want to talk about before we get to that is a weekly chart of the top 40 future here now. And this now goes back to late 2014, actually. So we've had effectively 3 years of very sideways, choppy, quite frustrating action really on our market. And I know a lot of fund managers that I speak to are very frustrated at the moment, because now the 3-year numbers, the 3-year returns are actually now starting to look really poor.
Yeah.
Because you've had 3 years of sideways. You know, previously they could always at least rely on the 3-year numbers or the 5-year numbers and say, well, it hasn't been that good this year, but don't worry, the 3-year numbers still look good. And now we're getting to a point where the 3-year numbers don't even look good anymore, because the market's gone sideways for such an extended period of time. Anyhow, we've been pushing up against the prior all-time highs on this market over the last week, and that comes in at about 49,400 on the top 40 future here. But what I want to point out there is that massive big bearish engulfing candle that we saw on the weekly chart last week. So keep in mind, every candle pattern here represents 1 week worth of trading action, and when you get a big bearish engulfing candle like that, what it means, you can see it's a red candle and it's very broad, in the so broad that it actually engulfs the body of the previous week's candle. That is a reversal, and the fact that it happened at that overhead resistance level is quite meaningful, and it suggests to me that we probably are in for a little bit of a pullback from here, which is not a bad thing. And I think if we were to see some sort of a like a healthy pullback, healthy consolidation from here, that would then potentially then set the stage for a more powerful rally out the top of that trading range. But I think to expect the market to continue to push out was maybe a little bit unrealistic. I know a lot of people were getting excited about it last week, but I think maybe it needs to consolidate a little bit further, build a base that it can then launch off to try and get a breakout to the top.
I mean, just, you know, if there is a pullback before hopefully some sort of breakout, because as you say, the fund managers very frustrated. They're probably now all pointing to their 5-year performance and 10-year histories. Would we benefit, or would we benefit enough given the option structure that you have?
Well, it depends when it happens. So no, at the moment we wouldn't. You mean if it pulls back? Yeah. Well, it would need to pull back below 48,000 for us to benefit. But there are ways I can also trade around the structure a little bit. So there's a couple of possibilities there. Yeah, basically in a short story, we need it below 48,000 though for our option structure to make us money by the September closeout, which is 5 weeks away.
Okay. And as you mentioned, you're not only bearish on the markets. In fact, 2 long positions that we'll be discussing on the show. But the first is actually a trade that you entered, and that was in the offshore portfolio last week.
Yes, we entered a trade in Unilever, and that is on our offshore portfolio, as you mentioned. It's listed in London, so it trades in pounds. And here's a chart of Unilever. What I identified was that there was a longer-term uptrend. You can't see, it doesn't go far enough back on the left-hand side, this chart, but that uptrend that I've put in there goes back quite a long way. And there seems to be an inverted head and shoulder structure over here, which has now begun to break to the upside, which is a bullish development. I also identified that there was this bull flag pattern, which looked as if it was also forming the right shoulder of that inverted head and shoulder structure, and I said at that stage that breakout through the top of the bull flag pattern looked bullish, and then if it started to push out through 44 pounds, which is the neckline of that head and shoulder structure, that would then be bullish for further gains. We've got a target here of 46 pounds. So I went long of 140 CFDs at 43 pounds 50 on the breakout there. Stop loss is below 42 pounds 50, which effectively means below the bottom of that right shoulder over there, and then my target is 46 pounds. So it's looking good. Today when I looked at it was trading at about 44.30 thereabouts, so we are on the right side of this trade. and I'm happy to continue to hold it while the structure looks favourable.
Yeah, okay. So things ticking over, and hopefully for the good this time, because it hasn't been a great year so far for the offshore portfolio. And then a share that you're monitoring locally, Clicks, very interesting because it has had a phenomenal year. And I think, in contrast to what a lot of people might have expected from a retail share, although Clicks, I suppose, finds itself in a fairly unique position in the retail sector. Yeah,
it does. Clicks and Dis-Chem are both stocks that have performed very well in the face of other retailers that have not done well at all. And I think it's because of their defensive qualities, their pharmaceutical business very much, and cosmetics and things like that. I know you wrote an article about it recently, I think, and you spoke about the lipstick effect, which was a very good article, I might add.
Oh, thanks,
and effectively it's saying that these kind of companies, Dis-Chem and Clicks, are actually quite well positioned to take advantage of a weak economic environment like we are in at the moment. So, but if we ignore all of that and just look at the technicals, what I like about Clicks is the fact that there's a very well-defined upward trend over here. You can see that quite clearly where it joins all those lows. The 50-day moving average has historically provided quite good support on pullbacks, and we now sit in a situation where the price is actually pulling back. There's strong support here at 140 Rand per share, which is where that long-term uptrend comes in. I would look for a reversal from that area at about 140 to buy, and then put a long trade on. So I think that's something that we're going to monitor for the week ahead. Because
a lot of people were sending us questions on Stockwatch asking about shorting Clicks, and I think it had got to a record, in fact, a little bit not too long ago.
Yeah, you could see at the beginning of August it was at a record high.
And people just felt that it was too steamy, and I suppose maybe to some extent that they were right, but I suspect that a lot of shorts got carried out because they were short maybe on the way up.
Yeah, this is the problem, and in fact it's interesting you mention that because Clicks is a stock that has a fairly high level of short interest in it at the moment. And from the way I like to trade, I look at that and I say, well, that's a strong stock, it's trending upwards. I would rather wait for the dips to buy and get on board that momentum rather than try and fight the momentum. Just from a probabilities perspective, you've got a far better probability of being successful if you trade with the direction of the flow rather than trying to fight it. So to me, it's not a short, it's more of a buy than anything else, in fact, because of the fact that it's got strong upward momentum on its side.
Okay, so it's not a position that you've taken yet, but it is one that you're looking at.
Yeah, it's on my radar to keep an eye on for this week, and I think if it pushes up and reverses off 140 Rand per share, then I'd definitely look to buy it.
And maybe just a comment before we wrap up the show and look at the portfolios. Garth, you've always been a natural bull, so it's been very interesting the positions that you've taken this year, and to some extent they haven't worked out, and it's almost contrary to your nature. They've been hedged positions, the option structures that you have against the market falling. And it's quite interesting just that you've taken an approach that seems to be contrary to what you would normally have done.
Yeah, no, you're quite right, and I am normally more of a bull by nature, but I also do like to try and sort of trade the market that I've got. And I think this year it has been difficult because there's been a lot of bearish sentiment around, not just locally but globally as well. And I think maybe I've been caught up a little bit in that, and that's clouded my judgment perhaps to a certain extent. The put structures that we've done on this show are effectively bearish structures. They're short, but they're not naked shorts in the sense that I'm going to get squeezed if the market goes higher. So, and I haven't got them all right, but yes, at the same time, I clearly haven't got the market direction right either this year. It's been a very difficult year.
Yeah, oh well, hopefully Clicks will provide some buying interest for us. Garth, so what does the portfolio look like? Not too much change, I imagine, from last week?
No, so the South African portfolio is actually exactly the same. We've still just got our option structure there, so no change to the South African portfolio. And then our offshore portfolio, that position in Unilever is making us some money. We're up £126 on that. So that's improved the performance on the offshore portfolio slightly over the week, but we've still got a long way to go to get back to the right side of the ledger here.
And then you have got a course coming up very shortly.
Yeah, this week, Saturday, the 19th of August, I'm doing a high probability trading course in Johannesburg. There is still space available, so if anyone would like to attend that, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Garth, we have to leave it there this evening. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.